You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
This sector, when you think about it, is like fascinatingly done in a sense, and so fascinatingly predictable. Because like Pierre Lassonde says, it's the easiest sector in the world because, and his simple reasoning is, it always crashes and then always rallies, and then always crashes and always rallies. We've had the crash. What's the next step? We know what the next step is. The question is, are we going to be there for it? The next big move in the junior space is obviously up. I know a lot of people are worrying about a crash, but it's like the crash has already happened.
Welcome to Mining Stock Education. My name is Brian Lenny. Today with me, I have Erik Wetterling, who is a private investor in the sector and the editor of the headlesshorseman.com. Today, you are going to hear Erik's thoughts on the market, how he deploys money into the sector, the lessons he's learned throughout his investing career, and much more. Erik, it's great to have you. Let's begin with how you deploy money into the market. Are you interested in a certain metal and that what propels you into the certain companies, or are you agnostic and it's like a company by company basis that you act?
I would say I have my biases. I mean, I got into the mining space from gold and silver. I started off buying second-hand silver coins and stuff, and then that became kind of boring because it's like even, you know, a quote volatile day, that's like, you know, 3% or something. And then I heard about these junior mining stocks that could go up 20% in a, and down, of course, more common, in a day. So that got me into gold and silver, and gold and silver junior miners, because yes, okay, I listened to all the, let's say, videos by the likes of, you know, Sprott and you know, Keith Neumeyer and stuff like that, and the debt bubble. And so it was basically leverage on that theme that, you know, everything is going to collapse. I mean, most of us gold bugs are kind of doomsday bugs. So it's like, you know, we're still waiting. And so that was my first way into miners. And of course, I mean, the learning curve is kind of steep. I mean, I got in 2015, which looks very, lucky in hindsight. But it took a few years to actually have a sense of what I actually owned. And I would say it's like I'm still learning. I'm trying to learn every day. I'm nowhere near, a geologist or a mining engineer or anything like that. My focus is typically has been the psychological aspect, and, you know, just getting a good investment strategy put together that could work hopefully over the, you know, long term. And of course, in this case, we have a cyclical sector, so, and it's always going to stay that way, even if the market always forgets that it's cyclical at every top and every bottom, and it's like a black swan event every time it happens. But I would say it's like I'm a bottom-up type investor, as like lately I've been looking at, I mean, one of my largest holders is nickel PGM play, because I don't have a particular short-term view on any metal really, but in that case it's just such a good company. So let's say I try to focus in on, or I would say I let the most important thing be the dictator, but I don't have any kind of, I would say, pure beta place that's just a bet on the commodity or any commodity in the, short to medium term future. I used to do that in 2015. I mean, then it worked, but I didn't know that I owned a trading sardine. I saw, oh, how many ounces in the ground does this company have? It's like, whoa, that's going to be worth a lot. But 10, 15 years later, it's probably not going to be built still. So I would say, yes, I'm a stock picker through and through. I have my biases towards some metals, but that also changes almost on a day-to-day basis. I mean, if I see copper up 3%, I get FOMO. I'm thinking the supply shortage is here, the green new utopia is here, and I want to, sell gold and silver, buy copper, and vice versa. But I simply try to stick to my guns and just, be a stock picker. I don't care too much what commodity it is, but it's like lithium, for example. That's so hard, I would say, to wrap my head around. I mean, it would probably take me months of research just to have an idea what I'm buying into in any kind of lithium company. So I've kind of been on the, let's say, on the fence in terms of lithium. Yes, I made some bets here and there, but it's like I don't have it within my circle of competence. So I have no idea if I'm making a mistake from the get-go, buying something that's never ever going to work.
Okay, so let's take that company approach. So there's, I don't know, 3,000 and something junior companies listed on the TSXV or on the TSX too. What attracts you to it? If the metal isn't what necessarily attracts you, is it the people? Is it a value proposition? What's the detail of what's your strategy?
That's a good question. I think it's hard to say. To me, this investing in the junior space thing, I find the hunt to be the most fun thing. The money is actually a bonus to me. Like, if I go back to my, time playing poker, it's not necessarily the, let's say, biggest pots you won, but the hands when you really outplayed an opponent. Those are the most fun hands, even if it's a small amount, but it's like you get the kind of satisfaction from that. So it's like, I treat the junior space as a game. And I would say that, what gets me into a company, usually it's, I think, if I find something that I think is important that the market simply doesn't appreciate, and it can come in a bunch of different versions. It's like, sometimes a team that's actually serially successful, sort of, can be underappreciated because the people that are now in the sector forgot about, their last success or whatever. So, or because typically, yes, the better or the more well-known teams, the serially successful ones, they tend to trade with a premium. But there are cases where a, really good team doesn't trade with a premium because it's, been unknown. It's like nobody that's left here remembers it. Just look at, this is it might be off topic, but it's like, think of the, newfound gold, for example. Would that ever have ramped like it did if nobody knew about Fosterville? Of course not. It's just the reference point there. And, I guess I'm going off topic as usual. But, no, I would go to say that I used to care less about people and just looked at the ounces, and now it's kind of progressing towards more and more about the people, more because in my mind it's like, okay, if I'm in this for the long term, if what's possibly correlated with a good management team, that's like returns over a longer time period. Give a good team a day to create value. You won't see the difference between a really bad team because they wouldn't have had the time to destroy value. But if I'm in it for the long term, because I think we have to be right now, given where we are in the sector, the next big move in the junior space is obviously up. I know a lot of people are worrying about a crash, but it's like the crash has already happened. So the next big delta is going to be to the upside. I don't know when that is. Could have started already. Could be a year from now, 2 years from now. So, okay, how do I make sure to catch that and make the most of it? I would say it's like, okay, let's say it can take anywhere from 1 day to 3 years. Okay, if you have a good management team, they probably won't dilute you to hell or actually create value over that time. So in that case, it doesn't really matter when it starts. Whereas if you stuck with the pure trading sardines with bad management, the more time you give them, the more time you give them to hang themselves and your investment. So I guess nowadays it's a lot about the people and especially like third-party validation as well. If you see, BHP or Newmont or Barrick or Newcrest buy into something at a particular price, unless you're smarter than them, that's a legit target or a legit project or whatever. So it's like, I think it's in some ways really easy to actually make a really good portfolio. But most of us, including myself, we're kind of risk counts in the sense that, oh, this junior is trading for 10 million or whatever. Or, I'm too late to the party on that 50 million market cap company or something. And we kind of take risks we don't need to, because I see a lot, people, throw their portfolios at me sometimes. It's like 80-90% of them I wouldn't touch, because I don't see the play. It's like, if I can't have a sense of what I think the future is going to look for a company, and that's obviously harder if the management team is bad and they don't really have a plan and you don't even see a path forward, then I'm not interested, because how am I going to have conviction when volatility hits? I'm not even looking forward to something specific from the company itself. So, I mean, I guess that's a long response. I don't know if I answered your question at all.
Well, how about this, though? Because there's a spectrum of risk and types of companies in the sector. You've got like the greenfield exploration companies that have nothing or just based on people. And at the very far end of the spectrum, you have the producer and royalty companies. I know you and I know what companies you're sort of interested in, but explain to us, like, where on that spectrum of risk and type of company catches your eye, because it's very different, depending on the type of investor you are, you're going to be attracted to those different companies. And, personally to me, that Lassonde curve is so true. So depending on where you hold it and what that company's doing matters. So where do you lay on that spectrum?
Well, I mean, I'm going to say that people ask me about royalty and streaming companies, and it's like, and I've heard, Pierre Lassonde talk about it, how beautiful that model is, that you're buying free upside or free optionality, etc. So it's like, in theory, that works perfectly, and is probably the best kind of investments. I mean, true investments. That's like, I mean, a royalty obviously makes money. It's not just on paper. It actually makes money, and you get that free optionality. You diversify the risk and all that. So on paper, I think probably prospect generators, and there's examples out there that I think are trading below their cash plus their equity holdings. So I mean, just at face value, it can't get any cheaper if you're trading at a negative EV almost. But I know myself that it's just too boring, because it's just too boring for me. So I'm much more into exploration plays, I would say. And the same thing goes for developers. It's like, I know there are some companies that's like, I'm 80-90% sure I'm going to make money on long term. And that's kind of rare in this business. I'm not saying I'm right in that assessment, but that's my internal estimate. That is like 80-90% probability of making money over the longer term. And that's obviously great, but it's like, I just find it, again, too boring. I'd rather take some risks. And I mean, I recently had a big hit in an exploration play, for example. And that's not, too fun, but it's like, you live by the sword, you die by the sword. If you're playing that game, you're getting exposed to the, potential high revaluation pace in such juniors. And of course, you're going to have typically more losers than winners. But like right now, for example, I think, Beta, proven success, is just have been going through the roof in terms of risk reward. Because in those cases, especially if it's a, low diluter, for example, it's like, the sector is going to turn around. There's 100% chance that we're going to have a bull market in the juniors, 100%. And then you can just back calculate, okay, what does a typical bull leg even do for juniors? Well, that's like, 500% for the median crap, shitco, as we like to call it. In a bull market, I mean, year 2000 to 2011, like, I have no idea, but we're talking an 11-year uptrend. So I know we're going to have a bull market, a bull leg. Most people, for some reason, forget it. Or I think most people they're more interested in the when, not the, that it's gonna happen, because everybody wants to time everything. If they think the bull market is 6 months from now, they think they should get out of the sector. If it's 1 month from now, maybe they're gonna start deploying capital in 29 days. But so I think beta is going through the roof in terms of risk reward, because in those cases, it's like we know what traditionally an ounce in the ground trades for at a bull high or a medium cycle high, let alone 2011 peaks, and we know how cheap they are now, and we know about the supply demand picture, which probably has never been more favorable. add the fact that we have gold at all-time high. So, I mean, I've never seen anything like this, but I would say, you know, the when stories are, you know, at peak merit, basically. And I think diversification is a peak merit as well, because if you know that the next big sector move is going to be up, I mean, if you invest in the sector, you know you're going to catch that ride. Whereas at the tops, then it's like, okay, if I'm super diversified right now, I'm going to get an 80% decline in my portfolio, especially if I'm holding shitcoins. So in those cases, I tend to go for alpha plays, you know, unknown stories, unloved stories, and they're, you know, few and far between. But it's like right now, there is no competition. It's like investing as an insider. You get to see the news releases. If they're good, you don't even have to pay up. So what's the difference? I mean, you know what I mean? If you knew the information before it came out, then you didn't have to pay up. So in essence, it's like being an insider. It's this sector, when you think about it, is like, I don't know. I mean, just fascinatingly dumb in a sense, and so fascinatingly predictable. Because like Pierre Lassonde says, it's the easiest sector in the world because, and his simple reasoning is, it always crashes and then always rallies. And then always crashes and always rallies. We've had the crash. What's the next step? We know what the next step is. The question is, are we going to be there for it?
Well, let's talk about price, because you've talked about value, and especially on the exploration end, I'm interested to know how you assign a value to the certain exploration companies, because, you know, you look at, there can be a range between a 5 million and a 30 million. And really on paper, outside of the people, I'm not sure always what the difference is. So how do you look at what is a good value for exploration?
Oh, that is absolutely, I was going to say, impossible to answer. I mean, I try to, I guess I got that from poker. I mean, the easiest thing, I think, is to just, let's say you have a junior and they have a major interested. And then you can just look at, okay, what's the market cap of the major? What do you think would move the needle for said major? What do they need to see? Their entire team of geologists or whatever that's done the due diligence, what kind of potential do they need to see? And then you look at the, you know, market cap of the junior, and it might be, you know, 20 million. So, I mean, if BHP is interested in something, for example, you know they wouldn't give two shits about something that at the end of the day could be worth 500 million. I mean, that's like throwaway money for them. So you know it's in the, you know, multiple billions territory. And then you look at the market cap of the junior, and you're like, it's, you know, even if you add dilution, yada, yada, it's pricing in, oh, a 1% chance of a BHP size price, or 2 or 3% chance. So, I mean, nobody knows what the exact chance of success is, obviously. But I think right now, especially in the sector right now, I mean, there's valuations out there where it's like either the larger company has to be brain dead, basically, or the Mr. Market is have to be brain dead, because they don't, you know, it just doesn't fit. It's like, okay, if it's pricing in, let's say, a 3% chance of success of finding something that's, you know, worth a major's time, I don't think they would, you know, spend the energy doing the paperwork if they thought it was a 3% chance. I mean, you probably can find a 3% chance on any project, any soil anomaly or something like that. So I try to, my version of a no-brainer is that you don't need precision. Because I have no idea how to exactly value, especially an exploration play. I just think of, especially if you have a major, for example, it's like, okay, we know the price is somewhere in the billions. Don't know if it's 1, 2, 3, 4, and it depends on the company size. And then I just look at price. It's like, okay, if no chance in hell is priced in, by definition, how can I be overpaying? And then, of course, there's a bunch of other stuff like, okay, maybe the threshold for success is kind of low, that even if they hit 30% of blue sky, you know, that might be worthwhile for a smaller company, or it might be a company maker in itself. Whereas, like, I mean, I remember when I wrote up Snowline, then we're talking like the highest threshold for success. It's like, okay, my idea was that they better find 8 million ounces in such a remote location, or it's a no-go. I mean, compare that if you had that target in Nevada, for example, where it's like, oh, 300,000 ounces is, the critical threshold for success, maybe. Then it's just a matter of, okay, they're definitely going to have 300,000. Then it's just a matter of how big the upside is. So it was kind of, I was going to say, risky in that sense. And of course, I guess it's like there's no simple answer, and I can't, give you a formula or anything. I just go by a case-by-case basis, and my approach, especially with exploration, it's simply that, aim for the stars and hit the moon and you might win. That's the kind of stuff I like to see, and especially if you're related to price. Obviously, I remember Garibaldi resources in like 2016-17, going up to 500 million market cap pre-assays. Then you kind of have to have something very, very significant, like, Voisey's Bay or something. But if the same company with the same project was valued at 30 million, you can afford to lose a lot of those bets, because in the ones that actually pay off, going from 30 to 3 billion, that obviously pays for a tremendous amount of losers compared to your win starts at 500 million and goes to 300. So of course you have to diversify away all the company risks. So it's like, I'm never all in on an exploration story.
Dude, so like that's a really good answer. And I totally agree with that looking big, like it makes a lot of sense to stick to the big potential. One question is, for big potential, especially when you look at jurisdictional risk, does going big mean you have to be more comfortable with jurisdictional risk? And I can say, like, you use Snowline as an example. And to me, more and more, I see jurisdictional risk personally as ubiquitous. Like, it's just in different forms, whether it's South America or Africa, like you can see the problems that they've had. But then conversely, in Canada, we've had problems too. And the Yukon itself, it's remote, like you said. The threshold is probably 8 million, 10 million ounces to get that road built, to get the permitting and stuff. So does size push you towards taking more risk on the jurisdictional end of things?
Yeah, I think you summed it up well. There's always versions of risk. And it of course depends on, I was going to say, the asset type or whatever. It's like, if you're just going to speculate on a drill play, you're going to get more for your money in case of success in Canada, even if that might have no shot of actually becoming something. I remember, again, going back to Snowline, some said it's like, okay, don't even bother. It doesn't matter what Snowline drills, because it's like, whatever, permitting might be hard or it's so remote. So it's like, that, in a sense, that's true. But my way of thinking was, that's not what the market's going to focus on if those drill hits come back with 300 meters or 2-3 grams per ton. That's going to create FOMO. That's going to, it became even better than I thought. But still, I think it's, again, a case-by-case basis. I have no problem. Again, I'm going back to the price. If it's a risky jurisdiction, okay, if that's priced in already, then it's fine. Yes, it might be high risk, but in case of success, in case they don't steal the product, obviously you're going to just make more money, because that's already discounted in the price. But I think it's interesting today, for example, it seems to be a real frenzy for, quote, tier 1 jurisdictions. It's like, I would guess, based on a rule of law kind of thing, the more civilized places, and more civilized places, but it's like the Western world, and a focus on permitting, because we've seen many deals in Nevada, and that's like famous for being easy to permit. And then we're seeing, a lot of very advanced or actually producing assets getting acquired, or miners buying other miners and stuff like that. So again, I'm probably giving you bad answers because I don't have any, specific way to answer it, but I would say I'm okay to take jurisdiction risk, and of course it depends on what you're after. Would I invest in someone who says we're going to be an organic or a producer with organic growth in Canada, that's like good luck. Even if you find something that's like 20 years, your mine that you're supposed to use to build a second mine, it will be out before you even get, the second project up and running. Then I would go to Africa. But then also, as the, I was going to say the Ross Beatties and Rick Rube say, it's like the geology is where the geology is. It's like, if you're going to go for big targets in the copper space, you kind of have to go to South America or the Macquarie Arc in Australia, whatever. And at the end of the day, the only thing we can control is price. So I'm invested in South America, I'm invested in North America, I'm invested in Australia, I'm invested in Europe, I'm invested in Sweden, because I have no idea what's going to happen with these jurisdictions. And some jurisdictions might be risky because they have a big mining sector, so the government might get a bit grabby, but some other jurisdictions where it's like, the mining sector is small compared to the GDP. I mean, mining is probably not even on their radar. So even if we have problems like we see, Canada raising taxes, the US raising taxes, and some people worry about Chile or whatever, it's like some places, like, they wouldn't give two shits about their mining sector, because it's like there's no money even to grab there, really. Yes, you'll get them maybe, if they increase the capital gains tax or whatever, but it's like, I don't know, it's like the future is like always Schrodinger's cat. I'm just trying to have a bit of everything. That's why I go with I own a bunch of different commodities. I'm in a bunch of jurisdictions. But I would say that I'm focusing more and more on the tier 1 jurisdictions, and that's mostly because that's what the majors seems to be focusing on. That's where the money appears to be heading. And of course, just if you're in critical metals, it's like, okay, the tensions with China is ramping up. Well, I would like to own what the West needs in the West in that case, because that's a free optionality on something going really bad with the supply chains, or they stop exporting whatever minerals. So I mean, there's just a thousand different angles one could deploy, I would say, and I can understand why a lot of people find investing in the juniors scary, because it sounds like there's a million things to take into account. But I think that's like to start off with. Now I'm going off topic again, but I would say for most people, it's like, just bet on the people that have done it before. I mean, it sounds boring, and it's like, you hear it. Everybody listens to Rick Rube, but how many of us actually listens to Rick Rube? I mean, that's what I would do if I was going to go away for 2 years and, thought, or set myself up to most likely make money in this sector without even needing to check the portfolio. I would just buy whatever the Lundins are into, whatever Ross Beattie is into, yada yada. Go away for 2 years. It's like there's probably 90% chance you're gonna make money. I mean, most people should learn how to walk before they try to learn how to run. So it's like, yeah, I mean, there's a lot of details to unpack in this, of course, but I don't know. Sometimes I feel like I'm almost doing a disservice by bringing up a million different things, and I think that might get people put off with the junior space.
You know what, Erik? No, I don't think so at all, because I think it is complex, but I think your comment about keeping things simple to start is very wise. Because you truly can't run before you walk. And I think that's the problem with a lot of newbie investors, is they get in here, they get attracted to something sexy, and they just have no clue. And so those are pretty sage, wise words. And I think people listening need to take heed of that and listen to you. How about portfolio allocation? Are you taking large bets on single companies, or are you spreading this out over 20, 30, 40 different companies? How do you allocate?
That depends on the opportunity set in front of me. I mean, sometimes I'm quite diversified. But sometimes if I find something that's just so compelling, it's like I become a real pig in those cases. Because, I've listened to Warren Buffett and Charlie Munger and even, Stanley Druckenmiller. Like, if you see something, I mean, you're kind of because the way I see it, I know some people have these fixed rules, like, never chase a stock, sell on a double, never put more than whatever 10% of your portfolio in juniors, and no junior to be higher than 5% or something. I mean, I don't buy into any of those rules, because you're just limiting yourself. Because, like, honestly, if you find something, like right now, there's a lot of juniors out there that I think are cheap. I simply think some are hundreds of percent, if you can measure that, cheaper than others. So, like, why would I cap myself and go with, a 2% position in something that is like, oh, this might be the best risk reward case I've seen in the last 5 years? So my short answer is that totally depends on the opportunity set. I'm not afraid to sometimes take very concentrated bets, but typically it's like I don't talk about that too much, because it's like people are going to think, oh, for sure that one's going to work out. No, if I knew it, I would be 100% in that one, obviously. So it's like, and now, for example, again, I think this is a matter of when from these levels that we're going to make money. So like diversification has probably never made more sense than now. And even in the junior space, even across metals. Yes, gold is at 2,350. So I love gold because I think gold juniors are actually the cheapest ones out there. I know I get some flack for that from like silver bugs, for example. But in my opinion, I mean, if we're talking more, safety, it's like, yes, silver and copper produce, whatever, they might have higher torque to a bull run in those metals. But the gold juniors, some of them are just obscenely cheap given where gold is now. That's like a speculative discount. I've never seen that before in this space. Even in 2015, you were buying projects and juniors that even if they found something would be worthless at an $1,100 gold price. So inherently you were speculating on the fact that you were buying stuff that was at face value worthless, even if they traded a 5 million market cap. But the bet was that I think the gold price is going to turn around. And in that case, when they go from worthless to actually becoming something, or become worth something, that's going to be a huge revaluation. Now in the gold space, you don't even have to take that risk. It's just the most remarkable thing I've ever seen. But at the same time, I can't, shut my eyes to the critical metals theme. And honestly, I don't want to feel like, I don't want to be in a position where I can be exactly wrong. If I go all in on gold and something happens that I have no idea what's going to happen, obviously, that's going to be, I'm going to feel pretty shitty if you see copper, nickel, lithium, oil, whatever go up. So I was going to say, now I am though somewhat concentrated, but that's because I can't help myself. Because some cases are just, I just think they're a bit unique. And again, I think I'm doing my portfolio a disservice sometimes by trying to limit my FOMO in some cases, because I mean, some juniors are probably better risk reward than 3 juniors with identical cases, and you get 3x diversification from a company perspective. But I think some juniors are just that much better than others, even though all of them might be cheap. So it's like, I think I can make money on a lot of juniors from these levels, but I do end up focusing more on the ones I really like. And that's also to keep it interesting for myself, because again, it's like prospect generators bore me to death. The best portfolio in the world might be to have 50 different prospect juniors, but I just can't do it. It's like, I'd rather go watch paint dry or something. It's like, that's not for me. I'd rather have big losses and stay at least entertained.
You know what, though? I guess I partially disagree with you in one aspect, because I know when I left my career in steel manufacturing and I was out on my own, private investor, no income coming in, and I looked at myself and I said, you know what? I need a set of rules to keep myself focused and disciplined, and that's still to this day, like I depend on taking money out of the market. Well, I've got my newsletter and stuff, and that's good income, but I want to pull money out. And so that really helped me, but that was introspective. That's like, I looked at myself and I said, I need these set of rules. I need to set limits and I think, honestly, I think that applies to more people. I think more people need structure rather than open end. But in talking to you, I can see for you specifically, it works. I think your experience and how your brain works, it works to be more, not loose, but to be more fluid in how you deploy money. So how does introspection how do you use introspection to adjust how you go into the market? Because it seems like you're pretty in tune with how you work.
I mean, first of all, just to touch on what you just said, I mean, I think you're totally right. And it's like I tell people, most people shouldn't even be in this sector stock picking. I mean, that's just because most don't have it in them really to suffer through the volatility. So I think a lot of those, let's say, psychological crutches is like you're using like kind of guardrails to keep you from doing too much, too big of mistakes. So I think that's actually very sound for like 95% of people. And that's where I was going with it. It's like, when you toss in a million different factors, then it becomes more of an art and not a science. But what was the question again? All right. Right. Yes. I mean, in poker, for example, you had to you ran sort of simulations in your own head, how you thought the opponent was thinking. And it's like, why did it take him 3 seconds to bet that much instead of 2 seconds? And then you kind of try to go through the way he thought about it, if he had the hand he's trying to portray that he has. And if it takes me 3 seconds to come to the conclusion that that bet is all right, and he bet in just 2 seconds, then I'm not buying that he actually has the hand he's trying to portray. So I think what I'm saying is that I try to check myself, because like there's I don't know if it's a saying, but it's like everybody thinks that their feelings are unique to them, but they're typically universal. It's like the fears and all of that, and I kind of know how I react. If I see metals ripping, I know I want to go out there and buy beta, the crappiest juniors there is. But it's like, I also know if I fast forward that tape, there's going to be a correction, maybe tomorrow. And then I know, okay, they're going down, and then I'm going to feel like a dumbass. So I always want to try to, let's say, test my investing theory or case to just, play the tape forward and go through a bunch of scenarios. Like, okay, if this case is, let's say, the base for this case is to hold it for 2 years. And then I, think about a bunch of scenarios that could happen in those 2 years. And that might be other metals going higher, volatility hitting, whatever. It's like a bunch of different scenarios. That's like, trying to stress test my case. Like, okay, if the idea is that, okay, if I buy here and hold for 2 years, I'm probably going to make money, maybe a lot of money. But if I can't translate that in practice, then it's like just a paper case. Let's say volatility hits, I bought it at whatever, it goes down 20-30%. And now all of a sudden it's like, oh, okay, now I don't feel like owning this anymore. And I mean, then you kind of have your proof that's like, yeah, on paper it made sense, or like in your head for a while it made sense, but in reality you might figure out that's like, I'm not going to be able to hold this. And that also translates in terms of what cases I like. I always want to think that's like 2 years ahead or something. So I always want to feel like the best is yet to come. So if I keep myself greedy, and I actually think this is a good idea, it's like, and try to be rational about it, but it's like, set the price target or value target in a spreadsheet or whatever for each company. It's like, what do you think this could be worth in 2-3 years? And then if, the number might be 10x what you paid for it today, And let's say you have an updating spreadsheet or whatever, you can see, oh, it's 700% from the 2-year target or something like that. I mean, I think anything to keep you greedy when you should, keep you in the game when you should, I think is usable. But I do, again, a big thing is just knowing yourself. Most people have no idea how they work. They say something, they might ridicule someone for acting in a way, and then they, let's say do a tweet about this exact same thing they were ridiculing, but now it's, how it relates to their portfolio. And it's like, I'm not perfect in any way myself, but I spend a lot of time just running through cases in my head and my portfolio and what could happen in the markets. Because now, for example, everybody's afraid of what happens if we have this recession that everybody's been talking about. And that makes me scared. Because then I'm thinking, yeah, we might have a, cascade selling, which we've seen a bunch of times, 2020, 2008, during the flash crashes. So that makes me want to sell immediately. Just reading someone say, oh, the yen is crashing, bank run soon, that makes me immediately want to go risk off. But then I just play, okay, do I know it's going to happen? No, I don't know it's going to happen. Everybody's been predicting that for a long time. What's the risk? What if I sell now and I'm wrong? Then I sold that maybe near the lowest price for the next 4 years or something. What if it happens? Well, if I'm looking at what happened the last crashes, in 2020, it actually rebounded within 3 weeks. So I could have, taken a vacation, gone through that, and, didn't have to worry about anything. So that just goes, I guess, to game theory. It's like where we are now in this sector, like even if we are not at the bottom, we're close enough. And if I think, okay, if it goes lower, the only change is that I can buy the juniors even cheaper. It's like I cannot lose in that scenario, but I can screw it up myself from thinking there's a way to lose, by trying to time the market. So I just check myself and find ways to, okay, if I know I get emotional about someone's tweet or someone's predicting this or that, I just try to go back, remind myself. That's why I, keep doing a lot of YouTube videos, just hammering home the same point. That's like, I know what to do here. And if a week passes and it's like, I might forget it a bit, it's like, I know what to do. We're past the point of selling. And I'm a big rant, but I would say that a lot of it comes back to like you being your own worst enemy. In theory, you know what to do. In theory, you know something's cheap. If that stock hasn't moved up for 2 months, you're going to stop believing that you were right. And then I think you have to, again, it's like find almost, I was going to say confirmation bias, like to keep you in the game, because all of us, I think, have bet on stuff. Then it's like, literally we hold out because, it's cheap, it's cheap. 3-4 months later, it's like, I'm giving up on this. The next day, poof, bottom is in, and you couldn't hold out. But if you actually, went back and actually got some confirmation bias by just refreshing your case, then I think you could hold out.
Does technical analysis work into your process for evaluating stocks? Or I'm not sure if you trade, but does technical analysis have anything to do with how you make decisions?
Not really. I mean, I do like to look at charts. I mean, I'm doing anything I can right now to keep me in the game. And that's like post a lot of memes, looking at charts that kind of confirms my, confirms my bullish thesis. But it's like, yes, I do look at it, but I don't remember the last time I actually bought anything based on TA. Because the way I see it as a value investor, I see a lot of juniors where you have that, clear downtrend resistance. And that's obviously just something for traders. There's nothing magical about drawing a line and see price hit that and not being able to push through. One could say that when you have those situations, that's like traders in a low liquidity environment subsidizing longer term value investors. That's the way I look at it. So it's like, oh, it didn't break through the trend lines. Like if you think it's worth 2-3x more, it didn't break through, it goes down. you should just buy more. Whereas, of course, as a typical trader, you would wait for the breakout. But if we're talking like now in this sector, when it's that cheap, there's no technical indicators that's going to say, by the way, in 2-3 years, you're going to be up 600% from this level. Because it's going to look like the bottom is falling out. I mean, especially in this sector, I've been, following it for a few years. I mean, nothing is more common than, false breakouts or false breakdowns. So I look at TA. I might use it for like longer term. Let's say, that gold's breaking out of $2,000 or $2,100. I mean, obviously, there's nothing magical about that except it's highly psychological. So I use it for maybe stuff like that. But hey, I was buying gold when it went down from 2,000 to 800, and there was no TA saying, oh, it's going to go up to 2,400. People were talking about $1,400 gold when that happened. So my short answer is I cannot afford really to do that because I need my buy and sell conditions to match at all times. Otherwise, it's not a strategy. And my buy and sell conditions are just buy if it's cheap, buy more if it's cheaper, sell if it's not cheap. So if I start to do like buy when it's cheap and then start to get TA involved, then it's like, well, they don't even match. I mean, it's, it breaks down, but now it's even cheaper. So, I mean, so your TA is saying sell, but your value investor approach is saying buy. So I think that's a big mistake a lot of people do, that they don't have a full circle or full cycle in terms of how they're going to make money. Because if you don't have something that you follow all the time, then you don't even have a strategy. Then you're basically, now I feel like doing TA, now I feel like being a value investor, and it just becomes a shit show. And I think that's what most people actually do in reality, in practice.
So you've been on your own as an investor in the sector for almost 10 years now. Can you share with us the biggest lesson, or maybe it's equated to the biggest mistake you've made, and how that has sort of changed the way you approach the sector?
Oh, that's a good question. I could probably think about this one for an hour, I was going to say. I mean, I would say like, or I would point out that I'm very bad at trading. I mean, I've tried it. I'm bad at, technical analysis, let's say, and all that. I mean, the only thing that always saved my bacon, or has saved my bacon, I would say, is that I'm very good at buying cheap. And I'm very good at getting greedy when it's warranted. Meaning that's like when stuff goes down and people run for the hills, I'm looking, because for some reason, it's like no one has ever looked at a, long-term chart on junior miners or miners overall. I mean, you can go back to the Barron's Gold Mining Index. If you would put a monkey in control of your portfolio that said, if this sector is down 50%, you start buying, then you buy more for every 10 additional percent it's down, that monkey would have a flawless track record. Because the sector never goes down forever, never goes up forever. Of course, a lot of the companies go away forever, most of them, but it's just to keep it really, really simple. I mean, that is, I know it sounds boring, because, I mean, I see, people on Twitter or whatever, they have like 1,000 different indicators. Every other podcast is about what the Fed is going to do. I mean, there's a million things you can look at that will get you to want to do something. And you can ask people about, the same thing, you get 1,000 different responses, and there's 1,000 things to look at. So I would say it's like just learning to shut off the noise, and it's like, and use any tool necessary to actually do that has been a big thing. And I would say one additional big thing is that, yeah, I mean, it really took maybe 5 years for me to really appreciate how important sentiment is. I started off thinking, because, coming out of university, that, I've just read the efficient market hypothesis. And I hear everyone is saying the market is always right. The market is always right. And it's like, what are we doing here stock picking if we even believe that? And of course, if the market would be always right, the worst thing you could do is pay a fair price. I mean, that's a pretty good, I was going to say a cushion, but that's not how it is. I mean, again, now in this market today, I just, appreciate more than ever that in the short to medium term, it's like literally 95% is sentiment. It is, yeah, and then it becomes, you're starting to, I don't know, reflect like, what are we even doing here? I mean, is this a joke? I mean, this is the most silly thing I've ever seen, that it's just a bunch of feelings being thrown around, and every downtrend gets exaggerated because everybody's betting that the next day is going to be the same as today, meaning down. And then you start to it's hard to take this sector seriously after a while, because you see that it's like nothing makes sense on the short, in the short term. So I think that's one big thing, actually, that people need to stop taking the paper losses, the volatility, that personal. It's like if my mindset is the market is always wrong, because it's an asymmetrical trade-off anyway. Any stock can go down 100% max, but the upside is obviously unlimited. And I want to be able to make a strong bet against the market when I think the upside can be absolutely substantial. Because the cheaper it is, obviously, the less right I need to be. Maybe 1 in 10 successes might pay for the other 9 if you're buying into a low, for example. So it's like it might sound very counterintuitive and to what people have heard, but I would say it's like stop thinking in days, weeks. Stop taking everything so seriously. Think of the market right now as a 5-year-old child just pressing buttons on the buy, sell, whatever. It's like nothing really makes sense right now from a long-term perspective, and that's okay. It's not going to make sense at the highs either. So I would say it's like the market is a lot dumber than many people believe in the short to medium term. And this sector is what you could make money just on the sentiment alone. But I would prefer, in my opinion, I think you would be better off going into the better quality companies, but they're still going to go down 50-60% when the markets throw a hissy fit, even though nothing has changed. And you can't take that personal. You got to say, this is bullshit. Nothing changed. I know nothing changed because there was no news release out saying it changed. And this is just the market being having a tantrum, which we're seeing right now.
In terms of people, or maybe even a book, is there anybody or a book that comes to mind that's had a huge impact on you and that you think other people can gain value from?
Well, I like Bob Moriarty's book, Nobody Knows Anything. The title alone kind of says it. And he has a very, straightforward approach, like buy low, sell high. And of course, and that's one of the, how theory gets translated to practice. Everybody says that phrase, buy low, sell high. What happens in the market is buy low because it can always go lower, and buy high because it can always go higher. And you see that all the time. But otherwise, in terms of books, I've read, Howard Marks, Warren Buffett. I like Monish Pabrai. I love to watch a lot of presentations by the value investors just to basically brainwash myself into thinking that price and value are different. And the only thing, how is an opportunity made? It's when they differ, right? And it's like, if they differ, you don't know when it's going to close. Like Warren Buffett says, call it magic, that the price will eventually sometime in the future cross where the intrinsic value is. And you kind of have to just believe that and brainwash yourself to everybody says this is the way to go about it. Again, if you're a value investor, price is different to value. Price changes every day. Value, in some way changes every day. But those would be the ones. So it's like Rick Rule, for example. I watch a lot of his stuff because he's the master of common sense. And it's like, it took a while, but when for myself to understand everything he was talking about, especially when it comes to mining investing, but it's like, it's so brilliant and he puts it so, as matter of factly, let's say. But a lot of people don't, and you can tell that he's kind of amused by, he amuses himself, I think, when he says something. It's like, this is how simple it is. But we know that when, theory meets practice, we go off in all kinds of directions. So those would be it. I mean, I think your show is great as well. And I just love hearing from other, investors, because there's for sure investors that are, better due diligence than me, a lot better at like share structure, some who have a different view or whatever. It's like, I'm looking at myself, I'm collecting tools for my toolbox. Like patience is a big tool, for example, but it's, and then some who might, have an idea, okay, this is how the share structure is going to affect something. I find the share structure too boring, but it's like, I know I got stuff to work it. So I would just follow, especially people that are good, because there's obviously a lot of people that, let's say, I mean, you get the sense that they're good, and what they say, it sounds like it makes sense, but at the same time, it's more like, just typical sayings or whatever. It's like, and you can't really translate it into anything pragmatic, I was going to say, to be used in the market. But it's like that's especially why I like, mining stock education. It's like you take people from different backgrounds and you get to hear different cases, scenarios. It's like how they think about this and that. And sometimes it's like, oh, I haven't thought about that. So, okay, now I'm going to take his strong suit or what I'm lacking. I'm going to incorporate that. And then I'm going to use that in my toolbox, how I look at other companies. But it's like a stair-step kind of thing. A lot of people want to become the best investors ever today. Swallow the whole, eat an elephant in one day. So I just, I listen to anything I can, but I would say I'm much more focused. I think investing in psychology is 90% and mining, engineering, and geology might be 10%, personally. And that's going to piss off a lot of geologists and mining engineers, but I don't think you need to be a mining engineer or a geologist. And I know what I think, are mining engineers and geologists, that I wouldn't give money to invest in this sector, even though they're really great at geology and at mining engineering. But investing in miners and mining are two totally different things, in my opinion.
Okay, how about two picks? What are your best ideas right now?
One I really like is Magna Mining. That's a nickel copper PGM play in Sudbury, Canada. It's like the most advanced junior in North America, I'm pretty sure. So it's like, when I think about the fact that the US, for example, has one operating nickel mine for a $35 trillion economy, I just find that absolutely hilarious. And of course, we know, well, the Indonesian, whatever, but that's obviously not going to be around forever. Then we have the, major players, even Agnico Eagle investing in a nickel junior. But in this case, for example, it's pretty much this being a very de-risked asset with most of the permits across two projects in a tier 1 jurisdiction. Because that's the hard part of these tier 1 jurisdictions. That's being allowed to mine. In some parts of, let's say, Africa or South America, it's like, yeah, you're probably going to be allowed to build it, or maybe, but are you going to get to keep it? Will it get blockaded? Will it get nationalized or whatever? So I think they have almost unique position, and I think the sentiment for nickel PGM juniors is absolutely crap, which is great. And I think they have one of the, you can't ask almost, you probably couldn't ask for a better team to try and do what they're trying to do, because a lot of the people involved are from FNX Mining. And that actually goes back to what I said earlier, that some teams are really good, but you don't even have to really pay a premium for them, because so few people remember the success they had. And in this case, it's like almost literally the same thing they're trying to do. But that success happened 2008, I think, somewhere along those lines. So this is more a bet on management, jurisdiction, asset, yada, yada. Basically, for me, checks all the boxes except not being gold. So, so this is one of those where it's like, it's so, in my opinion, I like it so much that it's like, you know, I have to, you know, be okay with it not being gold. And then I would say, I mean, the latest one I'm really excited about is First Nordic Metals. They're in Sweden, so I'm biased in that sense, especially because I find it so cool that it's in Sweden. I mean, they merged. I actually own two companies, Goldline Resources and Borsele Minerals. Both were like, I mean, Borsele was at, you know, multi-year lows, has a project with Agnico. Agnico hadn't done much on it for like since 2019, so everyone was just bored to absolute death. They used to have a market cap of like 178 million in 2017. It went down to like 24 million in market cap or something like that. And then you had Goldline, which owned the 50 kilometers of strike to the north of the deposit that Borsele had, and to the south. So it's like you could literally not come up with, you know, more obvious synergies. You have a big, Sweden's largest gold deposit in Borsele in the middle, and then you have the other company that owns this strike to the north and to the south. So I own both, and I wrote them up, and it's like, hey, you know, I would like these to be in the same company, obviously, because like you're sitting there with the margin of safety, you're sitting there with the exploration potential. I mean, together, that's great. You get everything in that case. So now they finally merged, and they brought Tashing in. And what I like about that is like the let's say one big success of Tash is when he was in Discovery Metals, and they acquired the Cordero project in Mexico, a big silver deposit. I remember I owned that in 2015, 16 or something for 17 million when it was in a company called Levon Resources. Anyway, so that was a forgotten, in that case, very low-grade Mexican silver deposit. Well, they acquired that. Within a few years, Discovery Silver traded up to $750 million. So, I mean, then we're talking, you know, a lot, kind of forgotten asset that actually was better than it looked and what the market gave credit for. So I'm hoping it's a similar situation here where Tash again is like, okay, here we have a sleeping asset. It's been forgotten by the market in a forgotten sector. And in time, I mean, I think it could become like 3 to 5 million ounces at least. And that's not even including Goldline's 100 kilometers of strike. But again, I own a lot of shares of both companies. I'm biased. Magna is a banner sponsor of my site. So it's like, as always, never ever put any money in any single stock if you can't see the case yourself. Because what's going to happen if you don't is that as soon as it goes down, you won't have any idea what to do, and you're probably going to sell low. And when it starts running, you're going to buy high. So that's just, you know, anyone listening, like, promise to never ever buy something just because I like it, because I can be wrong as well.
Right. Well, Erik, it's been a pleasure talking to you. I think we covered a lot of ground there, and I look forward to us talking again.
Me too. And again, it's like, apologies for the rants, but I hope some made sense.
Oh, definitely. Definitely. Okay. Until next time.